Okay, hello again. We're back. We're going to talk about inventory today, continue our discussion. We're going to look at these areas within inventory. Inventory is a big area in business and in accounting, a lot of issues. Okay, hello again. We're back. We're going to talk about inventory today, continue our discussion. We're going to look at these areas within inventory. Inventory is a big area in business and in accounting, a lot of issues. And we're not going to get terribly deep into anything related to inventory since this is an introductory class, but it does require some discussion. We'll talk about inventory methods, inventory held on consignment, how we calculate cost of goods sold under a periodic inventory system. The big area for today is we'll look at cost flow assumptions, FIFO, LIFO, average cost. We'll talk about lower of cost or market valuation, and then we'll end by looking at the inventory ratios, which help facilitate financial analysis. Okay, so that's what we're going to cover today, and that should conclude our discussion on inventory. All right, first, there are two primary ways in which businesses can account for inventory: the perpetual method and the periodic method. Now let's take a quick look at the definitions here. And in our previous lecture, we had actually looked at the journal entries for inventory under a perpetual method. That's the method that we're focusing on in our class here. And the journal entries that we talked about in the previous lecture is sufficient from your standpoint. Notice, perpetual inventory, we update the inventory account after each purchase, we increase inventory, and after each sale of inventory, we decrease inventory. And remember, we had those two journal entries. We recorded the sale at retail price, debit accounts receivable, credit sales, and then we had the second journal entry, debit cost of goods sold, which is an expense, and we credit or reduce the inventory account because we sold the inventory, we no longer have it. Okay, and so perpetual means perpetually updating inventory and keeping track of cost of goods sold. In a periodic method, or in the periodic method, we only update the inventory count at the end of the accounting period, and we determine cost of goods sold using our cost of goods sold equation after we've done our year-end physical inventory count. And we'll take a look at that equation momentarily. Okay, so we don't record cost of goods sold after each inventory sale. So inventory, businesses that use a perpetual method have closer track of their inventory at any point in time. The periodic method was very popular in the old days before we had networked computers and infrared point of sale scanners and barcodes and all that stuff. We can now, more and more companies can now use a perpetual system, whereas before it was very labor intensive. And so the periodic method was the predominant method, especially for retail-based businesses. That's starting to change now, but companies still have to be willing to make a sizable financial investment for all the technology necessary to allow them to effectively use a perpetual inventory method. Okay, so anyway, we're not going to worry about the journal entries for a periodic system. We've already talked about the journal entries under the perpetual system. So let's go ahead and look at what we call the cost of goods sold equation. Whoops, there we go. And it's a relatively straightforward equation, and don't make this more difficult than it really is. We start with beginning inventory. We add the purchases of inventory that we made below, and purchases, this top equation is sufficient for you. I simply wanted to point out that, notice we have a little asterisk that says see below. To determine the actual cost of purchases is a little bit more involved, and so it's worth a brief discussion. Here's our original purchases. If we are given a discount by our vendor, if we pay within 10 days, they sell it 210 net 30 like we talked about last time, we may save a little bit of money. So we would subtract the purchase discount from the original cost. In the event we had to return inventory, it was damaged, it was the wrong size, it was not what we wanted for whatever reason, then we would subtract any purchase returns and allowances, and that would give us net purchases. And you may notice that this is identical to the sales to net sales equation. It's just that now we're buying inventory from the vendor, whereas with sales, we were selling to the customer. So the first four lines, purchases minus discounts minus returns equals net purchases, was identical to the sales equation. But here, remember freight in. We are the buyer. When we buy it from our vendor, we normally pay for shipping costs, so we have to add the cost of shipping. That's what freight in is, shipping cost, to get the goods from the vendor to our place of business. And that gives us the actual cost of purchases. And it's the cost of purchases, the bottom line in the equation below, which we're using up top here, where it says purchases of inventory. Okay, I'll give you those numbers. Okay, so we take beginning inventory, we add the purchases of inventory that we made this year, using year as the period, and that gives us what's called cost of goods available for sale. That's everything we had available to sell to our customers during the year. What we started with, and remember, beginning inventory was last year's ending inventory. Then we bought a bunch of inventory throughout the year. That's our purchases. That gives us cost of goods available for sale. At the end of this year, December 31st, we do a physical inventory count, and just think, many of you on your jobs have helped to count inventory as part of your job. And that's what most companies do. Every company does at year end. They count inventory. And that's a physical inventory count to see how much we have of everything. And if we still have inventory on the shelves at year end, well, I guess we didn't sell them, or they wouldn't be looking at us in inventory. So we subtract ending inventory from everything that was available, and that gives us cost of goods sold, which I abbreviate CGS. Notice cost of goods available I may call CGA, and cost of goods sold CGS. So getting to cost of goods sold is relatively simple. Okay? I want to give you a really simple example so you really drive home the point here. I sell boxes. Okay, so my beginning inventory on January 1st, I have 3 boxes. That was last year's ending inventory. We didn't sell them. They're still here. So we begin with 3 boxes. To this, I add all my purchases made this year. I purchased 5 boxes, which means I had 8, I'm just going to write 8 boxes available to sell to my customers. At the end of this year, I count my physical inventory, ending inventory on December 31st, and we counted 2 boxes in inventory. If they're in inventory, we didn't sell them. So I subtract my ending inventory from what was available to sell, and that tells us how many boxes we sold, which in this case was 6 boxes. Now, if each box cost us $10, well, beginning inventory is $30 plus purchases of $50, cost of goods available for sale $80. Ending inventory cost us $20, so my cost of goods sold was $60. Very straightforward. Okay? And you may remember on our multi-step income statement, sales minus cost of goods sold equals gross profit. Okay? Now, if we sold boxes for $15, well, we sold 6 boxes, so my revenue, I'll just put it down here, sales would have been 90, cost of goods sold is 60, and I'll abbreviate GP, gross profit, would have been 30 at the multi-step income statement. So sales at retail price minus the cost of our inventory gives us gross profit. Okay. Consignment. I'm sure some of you have heard of consignment. And consignment is when a store does not want to buy inventory from a vendor because they're not sure if it's going to sell or not. And so what they do is they say, okay, give me 10 items of your inventory, and I'll put them on the shelf in my store. We'll agree upon a price. So for example, I'm trying to sell coffee mugs. Here's my coffee mug. And I go to a store and say, hey, you know, I think if you bought a case of my coffee mugs, you'd sell them, you could make some money. And the store owner's not so sure. So I say, look, let me give you a box of 50 coffee mugs. I'll charge you $10 a piece for each coffee mug, and I suggest you sell them for $14.95. And so the store owner does not buy them from me, but if the store owner sells a dozen coffee mugs, then he'll pay me $10 per mug for the 12 that he sold. That's consignment. From an accounting standpoint, the owner, that would be me and my coffee mugs in this case, I'm the consignor, the store is the consignee. Okay? I own the inventory, even though I put my inventory in the store. Consignee does not own my inventory. Therefore, notice on the slide, unsold inventory will go on my balance sheet. Even though that inventory is in the store, it goes on my balance sheet. It's my inventory. Okay? The consignee, the store owner, does not own the inventory, and even though it's in their store at year end, they do not include it in their inventory. Okay? And that's all you need to know about consignment. Okay, this is the big area we're going to cover today. Let me clear the board. Cost flow assumptions. How do we value inventory? So notice we have specific identification, and then we have FIFO, LIFO, and average cost. Specific identification is used for expensive inventory items. If I sell cars, I'm a car dealership, boats, Tiffany's jewelry, okay, expensive jewelry, I need to keep close track of my inventory. I know the exact cost of each Rolex watch that I sold or each Cadillac car that I sold because it's a very expensive item. However, if I'm Home Depot or Lowe's, it's not critical that when I sell a handful of nails or screws or bolts that I know the exact cost of this particular nail or bolt. Because I may keep a big bin of these things, and I simply dump them in when I buy them. And I don't need to put little price tags on each individual nail. That's not cost effective. What I do is I say, all right, you know what? I bought nails in January, and then March, and then May, and then July, and September, etc. I'm simply going to make an assumption, and that's what I mean by cost flow assumption, as to which items were sold. So if I elect FIFO, and FIFO means first in, first out, and write this down. The word in means when did we buy it, first in, and out means when did we sell it. And the key word here is assumption. First in, we assume, is the first one out. The first ones we bought, we'll assume we sold them first. And once the January nails were gone, then we sold the February nails. And once they were all gone, we'll assume we sold the March nails, and then April, etc. If, on the other hand, I elect LIFO, last in, first out, then I assume, and think of it this way, I buy nails and I dump them into the bottom of a barrel. So those are the January nails. And then I dump February nails in March. So the ones on top are actually the last ones in. So again, this is just an assumption. It does not have to actually mirror the actual physical items being sold. It's simply a cost flow assumption. We assume we sold the last ones that we bought, we sold them first. So that means the oldest ones remain in inventory the longest. Or we may just take an average of everything. We add up everything and we say, okay, here's the average cost for each item. We'll just, for every item we sold, we'll just take an average cost for each one. These are all acceptable methods. Now, the specific identification method is not an assumption. This is an actual exact number because it's an expensive item. But when I sell large volumes, millions of items a year, then using FIFO or LIFO or average cost is perfectly acceptable. GAAP, generally accepted accounting principles, accepts all these methods. So we pick a method, and remember that GAAP requires us to be consistent from year to year to year. So once we pick a method, we have to stick with it. We can't switch from FIFO to LIFO and back to FIFO simply because we want our inventory value to be higher or net income to be higher. That's exactly why we can't do that. So we pick a method, and we have to stick with it year after year after year. Okay, so what we're going to do is we're going to look at inventory and determine the dollar value of our inventory at year end, ending inventory, and we're going to figure out the cost of goods sold under each of these three different methods. Okay, and it's important to recognize the objective, the reason we're doing this, and you might want to write this down The reason that we are looking at inventory and using FIFO, LIFO, and average cost is to determine the dollar value of ending inventory and to determine the dollar value of cost of goods sold that's going to go on the income statement. That's why we're doing this. So when you get fused, you always got to go back and say, what am I doing and why am I doing it? That's why we're doing it, because we have to determine the value of inventory on the balance sheet and the value of cost of goods sold on the income statement. So we're going to do an example, okay, and here's our example. We're going to assume, okay, let's see. First of all, we assume that after we did a physical count of inventory, we had 700 units. Now, coffee mugs could be the unit, chairs, hats, desks, computers, whatever it is we sell. Think of the physical inventory, and then each item has a cost. And here is our accounting information. We have beginning inventory, which again was last year's ending inventory. We had 500 units in inventory. We paid $4 each for a total cost of $2,000. Now, in the United States, inflation is far more common than deflation. Deflation can happen. In Japan, it's happened for an extended period of time. But inflation, price inflation, is more normal in the United States. So we're going to make an assumption that prices will increase over time. If prices never changed, then all three methods would produce the exact same results. But in a period of rising prices, the three methods are going to produce different results. Okay, so here's the data we're going to work with. Beginning inventory, we have 500 units, 500 chairs, coffee mugs, whatever it may be. We paid $4 each for a cost of $2,000. In March, we bought 300 units. We paid $5 each. 300 times 5, $1,500. June, we bought 600 units at $6 each, worth $3,600. September, we bought 700 units, $7 a piece, $4,900. And December, we bought 400 units at $8 each for a total of $3,200. So we add up the physical units in beginning inventory, and we add up our purchases. Now, I'm just going to go back a few slides just as a reminder. Here it is. Look, beginning inventory plus purchases. We had 4 different purchases throughout the year equals cost of goods available for sale minus ending inventory equals cost of goods sold. And remember, the objective of this exercise, cost flow assumptions, is to determine the value of ending inventory and cost of goods sold. Okay, so we're back. So beginning inventory plus my 4 purchases equals 2,500 units available. 500 plus 3 plus 6 plus 7 plus 4, 2,500 units, physical units available, and the cost of goods available, the dollar value in total, is $15,200. Okay? Now, here's a useful piece of information. This data, beginning inventory, purchases, and cost of goods available, remain the same. The values are the same for all 3 methods, FIFO, LIFO, and average cost. What will be different is my ending inventory and my cost of goods sold. So let's go I'm going to start working on the board here. First of all, I'm going to put these numbers up. Here's beginning inventory. I'm just going to abbreviate. And that's $2,000. Here's FIFO. Here's LIFO. And here is average cost. Okay? Plus purchases. And our purchases in total, if you add up 15 plus 36 plus 49 plus 32, is 13,200. This gives us cost of goods available for sale, 15,200. It's the same for LIFO, and it's the same for average cost. Okay, and so we're going to determine what's the value of ending inventory and what's the value of cost of goods sold, and we're going to look at FIFO first. First in, first out. We make this assumption. It doesn't have to mean we actually sold those physical units in that order. We're simply going to assume we sold our beginning inventory first, Then we sold all the stuff from March. When that was depleted, we sold the June items, then September, December, etc. Now notice on the bottom of the slide, assume after we counted inventory, we still had 700 units in ending inventory. So therefore, if, and I'll squeeze it in over here, if I had 2,500 units and 700, can we see that okay? 700 units right here? Okay, very on the edge. So that's why I'm saying it several times for you students out there in computer land. That means we sold 1,800 units. Okay, I'll push this back briefly. Okay, so 1,800 units sold. If we had 2,500 units available, 700 is still in ending inventory, we must have sold 1,800 units. So we now have to determine the dollar value of ending inventory and cost of goods sold, and they'll be a little bit different for each one. Okay, so hang on to those numbers, and let's take a look at FIFO first. If we sold 1,800 units, first in, first out, I must have sold 500 from beginning inventory first. Those were the first items sold. Okay, so under FIFO, cost of goods sold, put it down here a little further down, cost of goods sold, I sold 500 from January 1st, 500 times $4 is $2,000. Now I'm going to keep a little running scorecard. We sold 1,800 units, right? 1,800 units were sold. I'm writing a little bit small there, I apologize. Here's the first 500, and that means we still have 1,300 units to account for. So once the beginning inventory is gone, I assume that I sold the March items next, and that would be 300 items at $5 a piece, and that's $1,500. So I'm going to subtract 300 units. I still have 1,000 units I have to account for. So beginning inventory is gone, March items are gone. I'm going to assume that I sold the June items next, first in, first out. They were the next ones in. Okay, so June, 600 items times $6 each is $3,600. Okay, I'm going to subtract those 600 units, and I have 400 units left that I have to account for. And here's the trick, so watch carefully. In my September purchase, I had 700 items that I bought. I have to split that. 400 were sold, 300 are still in ending inventory, not sold. So from the September purchase, we bought 700, I sold 400 of them, which means 300 of them have not been sold, they're still in ending inventory. So from September, 400 items times $7 is $2,800. And look, here is my 1,800 units sold. I know I'm blocking your view. Here's the 1,800 units sold. Okay, and now I have to figure out, this is my cost of goods sold right here, CGS. All right, so we got what, 35, 65, 71, 79, 9,900. There's my cost of goods sold. Now remember, my cost of goods sold equation, from cost of goods available, I would subtract ending inventory, and that would give me cost of goods sold. I'm going to put a little squiggly line to give you visual separation. And we know that this number is now 9,900. Okay? Cost of goods available minus ending inventory, X, right? We don't know it, equals 9,900. We could also say 15,200, cost of goods available, minus cost of goods sold, gives us ending inventory. So there's two different ways that we can calculate ending inventory. All right? And so if we add up, we can either say 15,200 minus X equals 99, or 15,200 minus 99 gives us ending inventory. And our ending inventory in this case would be 5,300. Okay, so this is what we call the shortcut. But we're going to take the long route, and we're going to prove ending inventory is 5,300, assuming I did my math correctly. September. I still have those 300 units left, which I did not sell. I paid $7 each for those. That's worth $2,100. And December, I didn't touch those. Those are my last in. Those are still in ending inventory. 400 times $8 is 3,200. Here are my 700 units that are in ending inventory, and we physically counted those units, worth $5,300. Okay, so we just proved what ending inventory is, but notice we could figure it out simply. It's the missing number. Cost of goods available minus X equals cost of goods sold. We figured out cost of goods sold. I backed into ending inventory. Or I could prove it. And in fact, notice what I did. For cost of goods sold using FIFO, first in, first out, I started from the top and I worked down for cost of goods sold, and I accounted for the 1,800 units that I sold. I could have also started from the bottom and worked up to calculate ending inventory first. So I could have calculated ending inventory, plugged it in up here, and I could have determined cost of goods sold using that approach as well. So you can calculate either one, okay, and then back into the other number. Whichever works for you is the method you use, okay? So we just calculated both ending inventory and cost of goods sold using FIFO, first in, first out. The oldest stuff is the first in, and beginning inventory by definition is always first in. March came in before June, June came in before September, etc. Now we're going to look at LIFO, last in, first out. So I got to erase these numbers here. Okay, we're still going to calculate cost of goods sold. And notice these three numbers, beginning inventory purchases and cost of goods available for sale, stays the same. But ending inventory and cost of goods sold will be different. So let's take a look at LIFO, last in, first out. If the last one's in where the first one's sold, that would be the December items. So the first one sold were the goods I bought in December. There were 400. I bought them at $8 each. That's $3,200. And again, I'll keep my little running scorecard over here. We sold 1,800 units, right? There's the first 400. I still have to account for 1,400 units. So if all the December items have been sold, the next ones that were last in would be September. And there were 700, so I must have sold all of those as well. September, 700 times 7 is $4,900. So those items were sold. So I'm going to subtract these 700 over here. I still have 700 units to account for. So after December was gone, then September. After September was gone, I go to my June purchases. In June, I bought 600 at $6 each. That's $3,600. So I just accounted for 600 more units. I have to account for 100 units more. And so again, we're going to have to split one of those purchases. Think of it as layers. The layers sometimes get split. In this case, March, we bought 300 of those units, but 100 of them were sold. That means 200 are still in ending inventory. They weren't sold. So for cost of goods sold, March, I'm going to take 100 of those items at $5 each. That's $500. Again, here's my 1,800 units sold. And my cost of goods sold, again, here goes with the math, 81, 87, 11, 7, $12,200. That's my cost of goods sold under LIFO. Okay? So I'm going to plug in cost of goods sold, 12,200. All right? 15,200 minus X, ending inventory, gives us cost of goods sold. Okay? Well, ending inventory, therefore, 15,200 minus 12.2 is $3,000. That's my ending inventory. Okay? And again, we're going to prove that 3,000 is an accurate number. Okay, so here's my cost of goods sold. I'm going to put it down here. Cost of goods sold. Ending inventory, EI. I'm going to abbreviate. Ending inventory. From March, I have 200 units left that have not yet been sold. 100 were sold, 200 not sold. So March, 200 items. I paid $5 each. That's $1,000. Okay? And my January beginning inventory, from January 1st, I had 500 units that I paid $4 each. That's $2,000. There is my 700 units in ending inventory, valued at $3,000. So we just proved ending inventory is in fact $3,000 under LIFO. Okay? Last in, first out. So I figured cost of goods sold, starting at the bottom, working my way up until I accounted for those 1,800 units. Or to calculate ending inventory, I could have started at the top, beginning inventory, and accounted for the 700 units. Once we have either one of these numbers, we can figure out the other one. Okay? And notice, cost of goods sold with FIFO is $9,900. With LIFO, it's $12,200. Why? Because LIFO assumes we're selling the most recent and more expensive items first, which means the less expensive items are in ending inventory. FIFO, we are selling the older, cheaper stuff first, so cost of goods sold is lower. And then the more expensive, more recent purchases are still in ending inventory, so my ending inventory with FIFO is higher. And so they're going to produce different results. And those differences can be quite significant for big companies, literally in the billions of dollars for very, very large companies. And so they have to disclose when they use FIFO or LIFO, especially with LIFO, what their inventory would have been had they used FIFO. But they would put that in the footnotes. Okay, so we have FIFO and we have LIFO. The last method is called the average cost method. So I'm going to clear the board. And average cost is actually the easiest of the three. To calculate average cost per unit, simply take cost of goods available for sale, which in our case is $15,200, and we divide it by the number of units available for sale, which was 2,500. 2,500 units were available for sale, and this gives us an average cost of, I think it was $6.08. You should be plugging it into your calculator. $6.08 per unit. $6.08, 6.08. Now what I'm going to do, I'm going to take this average cost per unit. For cost of goods sold, I sold 1,800 units. So 1,800 units times 608 is going to give me cost of goods sold of $10,944. And my ending inventory, we had 700 units at an average cost of 608, and that's going to give us 4,256. Okay, and so let's plug them into our formula here. Cost of goods sold, 10,944, and ending inventory, 4,256. And recognize that if you have a rounding calculation, like for example, if 608 was it really 6.07842, whatever, if you round to 2 decimals, you may have a slight rounding error. And that means these numbers wouldn't mathematically work. They'd be off by $1 or $2 or a few bucks, but you should be able to recognize a rounding difference. Okay, so let's take a look at these 3 methods. Average cost was quite simple. Simply take cost of goods available, 15,200 on your slide, divide it by the number of units that were available, which is units in beginning inventory, plus units purchased, 2,500. That gives us an average cost of $6.08 per unit. Now be careful, do not do the following. Do not add up 4 plus 5 plus 6 plus 7 plus 8 and divide by 5. That will not give you the correct answer. That is wrong. Do not do that. This is a weighted average because we didn't buy the exact same number of units at the various prices, so that approach won't work. So this is how we calculate average cost per unit. Then we take this average cost per unit and we multiply it times the number of units sold, 1,800, and the number of units in ending inventory, 700, and that's how we figure out the dollar values for each of these items. Okay. Notice that weighted average, or the average cost method, always produces numbers in between. I'm going to step aside here. Notice how cost of goods sold for average cost is less than LIFO but more than FIFO, and same thing for their ending inventory. Ending inventory is less than FIFO but more than LIFO. And so it always produces results in between FIFO and LIFO. When you have rising prices, if you had falling prices, everything would be the exact opposite. Okay? FIFO's cost of goods sold would be higher than LIFO's. But in America, inflation is far more common than deflation. Okay, so this is how we calculate inventory, ending inventory and cost of goods sold using FIFO, LIFO, and average cost. Now notice that if cost of goods sold is different, think back to your multi-state income statement. Sales minus cost of goods sold gives us gross profit. Then our income is going to be different with the three methods, and therefore our taxes will be different. Let's take a look at a slide that illustrates this. Okay, so here's our numbers. If I transferred them correctly, 99, 12, 2. Okay, assume, look at the bottom, assume that sales revenue is 20,000 and that our operating expenses, which have nothing to do with inventory, are 4,000, and we're in a 30% tax bracket, we'll just assume for federal income tax purposes. If revenue is 20,000, cost of goods sold for FIFO 9,900, gross profit 10,100, minus operating expenses of 4,000 gives me taxable income of 6,100. I multiply 6,100 times 0.3, my 30% tax bracket, and taxes are 1,830, net income 4,270. Under LIFO, same revenue, but cost of goods sold is higher, 12,200. Therefore, gross profit's lower. Subtract my operating expenses. Taxable income's 3,800. Multiply that times 0.3 for your taxes. You get 1,140. Net income, 2,660, quite a bit lower. And then average cost will be in between the two. Revenue 20, cost of goods sold gives you gross profit minus operating expenses. Taxable income, 5,056 minus your taxes of 30%. Net income, 3,539. So the three methods will produce different results. On the balance sheet, your inventory will have different values, and on the income statement, your income will be different as a result. So these are important issues. Okay, so try to make sure you understand how to calculate FIFO, LIFO, and average cost, and recognize the financial statement impact they have on both the balance sheet, the inventory account, and on our calculation of income, including taxes. Okay, a couple of other items we want to talk about. After we've figured out FIFO, LIFO, or average cost, this is our cost using one of these assumptions. That's our actual cost data. We have to perform what we call a lower of cost or market test, okay, which is sometimes abbreviated LCM, lower of cost or market, and we're literally comparing two different numbers. Cost, using FIFO, LIFO, or average cost, and market. Now notice on the slide, market, somewhere up there, refers to our current replacement cost because we are the store that's selling the goods to the customer. We're not the customer, so this is not retail price. You typically think of market as the retail price. We're the store, so our definition of market is how much would it cost to replace that inventory today. So we're going to compare cost to current replacement cost, which we call market. Normally, in rising prices, it'll cost us the same or a little bit more to replace that inventory today than when we bought it a few months ago. However, there are times when inventory may drop in price due to economic reasons. And we're going to talk about a few of those. And this is why we conduct this lower of cost or market test, because sometimes inventory drops in value. I'll give you a few examples of why this is an important test. Children's toys. Okay, several years ago, long time ago, we had Cabbage Patch Kids and Mighty Morphin Power Rangers and all these toys from TV shows and cartoons that the kids had to have, and parents were literally fighting in the aisles trying to get the last one on the shelf. And the stores recognize that when you have a hot item, you can raise the price. But a year or 2 or 3 later, these items fall off a cliff and no one's ever heard of them, and they certainly don't want them anymore. So if a store bought too many of these items when they were at a high price, and preferences have changed, the kids have moved on to a different product, then if they were to replace this item, it would cost them far less. So their cost data is too high. The inventory has dropped in value. The term that's used in accounting is it's impaired. We have an impairment in the value of inventory. And we have to show that impairment when we identify it. It's going to result in a reduction in the value of inventory, and we're going to have to put that difference, that loss, on the income statement. We call that literally loss on impairment of inventory. Same thing if I'm a computer store and I bought too many computers a year ago. We all know that computers drop in value quickly because technology keeps making faster, better, more powerful computers. So if we paid $600 a year ago, that same computer we could probably buy for $100 or $200 today. And so on our balance sheet, we can't carry that old inventory at the cost, our original cost, using FIFO or LIFO. We have to drop it in value to current replacement cost. That's what we call the lower of cost or market test, is when inventory has dropped in value. Okay, we've had an impairment. We have to show the reduction on the balance sheet, and we have to report that loss, the difference between the original cost and our current replacement cost. That difference is the loss that goes on the income statement. And that can be significant, so we have to show that. That's a requirement of GAAP. The last item that we want to talk about today are the ratios. Okay? And remember, your ability, since most people who take accounting at the lower division level, it's a requirement for all business majors, but most of you guys are not going to be accounting majors. You're going to be managers, marketing, finance, information systems. You're going to be in business. You need to understand financial information. And so really, it's very important that you are able to look at income statements and balance sheets and cash flow statements and make sense out of it, and to also evaluate financial information. And we do financial analysis and ratio analysis for this exact purpose. Inventory is a very large asset for most retail businesses, and you have to manage inventory very carefully. If you buy too much inventory, you get stuck with too much inventory. You have a lot of money tied up in inventory. It may not sell that quickly, and it's a problem when companies have too much inventory. Okay? Not to mention, storing inventory is a very expensive process. The building, all the shelves and forklifts and trucks moving stuff back and forth. So companies don't want to have too much inventory. At the same time, if you don't have enough inventory, you run out, and your customers go to your competition to buy what they need. So you don't want to run out. You don't want to be stuck with a mountain of it. You have to balance your inventory carefully. Okay? And so we have to manage inventory carefully. And we have a couple of ratios, the inventory turnover ratio and another one called the number of days sales in inventory. And we look at this to measure how well we're managing our inventory. And remember, with ratios, you always want to compare it to last year, the year before, compare it to our main competitors, to our industry as a whole, to get valuable feedback. To calculate inventory, we take cost of goods sold, that's our numerator, and we divide it by average inventory. Anytime you hear the word average in a ratio in an accounting class, the way we calculate average is we take the beginning of the year balance on January 1st, plus we add the ending balance on December 31st. We add those two numbers together and we divide them by 2, and we call that an average figure. Okay? And we're going to do that here. So our data, we have cost of goods sold of $1 million. January 1st, our inventory was worth $240,000, and at the end of the year, December 31st, it was worth $260,000. So my average inventory, I take 240 plus 260, I divide it by 2, and I get $250,000. That was the average level of inventory throughout the year. Okay, now, if my cost of goods sold was $1 million and my average inventory level was 250, that means I sold my inventory 4 times throughout the year. And here's a graph which kind of illustrates that. Here's December 31st, here's January 1st, here's the middle of the year, July 1st. So we have 4 quarters, and let's just say this is $250,000, 250K. All right, then it means 4 times throughout the year, I was able to sell inventory of $250,000. Inventory, we always record at cost. Of course, we do that lower of cost or market test, but let's just assume we carry it at cost. We don't carry inventory in the balance sheet at retail value. We carry it at cost. Therefore, we use cost of goods sold, not sales, because sales includes the markup at retail. So cost of inventory divided by the inventory on the balance sheet tells us how many times we sold our inventory. We sold $250,000 of inventory 4 times throughout the year. Now, we didn't literally do that. So the second ratio takes the exact same information, and it says, how many days did it take us, on average, to sell our inventory? So if our inventory turnover ratio is 4, then I simply take 365 days, and I divide it by my inventory turnover ratio, and what that tells me is that it took approximately 91 days for me to sell my inventory. If inventory turned over 4 times, okay, each month 30 days, it took about 3 months for me to sell my complete inventory. Now, of course, stores don't wait until they're completely depleted before they completely restock their shelves, but conceptually, it tells us how fast are we moving our inventory. Now, is this good? Is this bad? It's really hard to say, so what I need to do is compare it to last year, the year before, compare it to how my competitors are doing, so I can see, are we doing a good job of managing our inventory? If I think 91 days is taking too long, I need to accelerate or speed up how fast I sell my inventory. Okay, and then I need to either carry lower levels, provide incentives to move the inventory more quickly. I can do things as a manager, but this provides me important feedback as to whether I'm doing a good job of managing my inventory or not. Okay, these are commonly used ratios, and you really should make a point to try to know these. Okay, so we've covered the primary points in inventory, had a couple of lectures to do so, and all this stuff will get tested, so do yourself a favor and take a good hard look at this stuff. That's it.